We'll start with the risk management part where we stopped last time. I think you can see the presentation.
Yes.
Yes. Okay. So we discussed basics of risk management, then what are the different types of risk that we face as a financial institution. Then we discuss about market risk, bit more detail in market risk, how to manage interest rate risk, at least how to measure interest rate risk, gap analysis and things. So we discuss value at risk. I told you that FX risk we will take it separately, and probably next two session would be mostly on foreign exchange risk. Equity risk and commodity risk, I just gave a brief knowledge on that, but where we stop here, market risk, we stop at that point, and we have to start credit risk. So I'll start with this credit risk and move on to the FX risk more detail. Before we move into this, is there any other question? Any questions on what we discussed so far on credit risk? Sorry, risk management. So if you don't have any questions, we'll go ahead with credit risk. What does it mean by credit risk? Credit risk is the risk that a borrower will default. That means borrower may not be able to meet his or her obligations on time. That means make a payment. It may be a principal or maybe interest payment, due amount and on due time. So that basically that's the credit risk. So failure of a borrower. But again, this credit risk at this level, we consider it at different levels, not only at the default level, that means failure of a payment, even a credit rating downgrade, it's sort of risk. So basically borrowers, institutional borrowers, they have credit ratings. They get credit ratings based on their credit worthiness. There are credit rating agencies. Credit rating agencies analyze the books of corporates or firms, financial institutions, and assess what is the credit worthiness of that firm. Based on that, not only firm, even governments or any borrower. So based on that, they assign a rating. But with the time, if the credit worthiness goes down of a particular firm, the credit rating agency will revise the rating issued by them. So it may be a downgrade. So if that downgrades happen, value of assets that we are holding will get affected. Whether it's a downgrade or upgrade, the value will get affected. So therefore, we consider that as a credit risk. But basically, credit risk means the borrower's inability to whether it's inability or willingness, but borrower default is considered as credit risk. We'll discuss some few variations when we move forward. One way of measuring credit risk is assessing the expected loss that we may incur due to a credit event. To calculate the expected loss that we may incur, we need three more parameters. First one is probability of default. That means what is the chance that a borrower will default. Probability of default is that's the chance. What is the chance that a borrower will default? So credit rating agencies again at different for different ratings. Ratings comes from AAA, AA, plus AA minus, like that. So for each and every rating category, rating agencies announces what are the probability of defaults. Basically, they give a transition matrix. What is the probability that a AAA firm will move into a AA plus category within a 1 year. Likewise, they give that matrix. We call it a transitional matrix. Based on that transitional matrix, we can derive probability of default. Or otherwise, the given equation we can use to calculate the probability of default. That means in one particular category, maybe rating based on rating or maybe based on industry, within a particular category, what's the total number of borrowers prevail at the beginning of a particular period, say 1 year. At the beginning of the year, how many borrowers were there in a particular category? Then at the end of the year, out of that borrowers, how many borrowers defaulted? So that ratio, number of borrowers defaulted divided by the total number of borrowers, we can take it as a probability of default. So probability of default basically gives us an assessment. What is the chance of defaulting by a borrower within a single time frame? Generally, we assess within a 1 year period. The next one is, if the borrower default, in some instances we may be able to recover part of it. Whatever the due, we may not be able to recover 100%, whatever the total amount due for us, but we may be able to recover part of it. Again, as a proportion or as a percentage, what is the rate? That is, we call recovery rate. What percentage that we can recover? We call it recovery rate. So if there's 100, we can recover only 40. What would happen to the remaining 60%? We lose it. So the next term, loss given default, refers to that. If any default occurs, what is the loss that we may incur? Remember, this is if a default occurs. That's why it says loss given default. So we assume the counterparty has defaulted. If the counterparty defaulted, what is the proportion that we can? What's the proportion that we may lose? That is loss given default. So we can calculate the loss given default as 1 minus recovery rate, because we have the full exposure 1 and we recovered portion of it. The remaining part is the loss. So therefore loss given default is defined as 1 minus recovery rate. Then the other important factor what we have to assess is what would be our exposure at the time the counterparty default. So it may be a loan granted few years back, say 1 million rupee, 1 million rupees loan given for a 10-year granted for a 10-year period. Now 5 years has gone. So the balance capital part may be 800,000 rupees. If the counterparty defaulted today, your exposure is only 800,000, not 1 million, because part of the capital has already recovered. So remember that exposure at default, it may or may not be the full amount that you grant, depending on the product. So when we have these three variables, probability of default, exposure at default, and loss given default, we can calculate the expected loss. This equation gives you how to calculate expected loss. That is probability of default into exposure at default into loss given default. This will give you a quantified figure if the counterparty, with the exposures to a particular counterparty, what is the loss that we may incur within a 1 year period. It may not realize, or it may vary, because the probability of default may vary, exposure may vary during a 1 year period. That can happen, but this is what we expect. Then the unexpected loss is what we actually realize if a loss happens. Basically, what mostly matters is unexpected loss, because for expected loss, we consider that when we price in the product. When you charge interest rate on a loan from a customer, you consider the expected loss due to a credit event. What would be the loss we may incur due to failure of a borrower, or if borrower default. Then we add some premium into the interest rate to compensate that risk. But unexpected loss is not like that. We don't know. So that is the portion that we may have to consider seriously. So difference between expected loss and the real loss, it matters in real life. So what we expect from you to understand what is a credit risk and the measures of credit risk, basically expected loss. To calculate the expected loss, you need to know three parameters: probability of default, exposure at default, and loss given default. Remember, loss given default can be calculated using the recovery rate. So it may be you straight away assess the loss given default or recovery rate. If you assess the recovery rate, you can calculate the loss given default as 1 minus recovery rate. So we discuss about credit rating. Credit ratings are issued by credit rating agencies in the global market. There are three major credit rating agencies: Standard & Poor's, Fitch, and Moody's rating agencies. Those three are the major players in the international market. But in Sri Lanka, we don't see all three rating agencies. But in Sri Lanka, we have another firm called Dtrm. So a single party may get credit may be rated by all three firms, three or whatever the available firms, or maybe just by one rating agencies. However, the rating, as it mentioned, what they do, they just rate the firms and give the highest rating, which is AAA. That means AAA, AAA rating for the best firms. Each rating agency has their own criteria, their own methodologies, how to assess credit risk, and how to assess how do they assess assign the rating. However, higher the rating, lower the probability of default. Lower the rating, higher the probability of default. So then triple B minus and above we consider, or basically triple B and above. That means highest rating is AAA, then it goes down gradually. Triple B is and above, that means triple B to triple A, we consider them as the investment grade. Below that, we call them junk. So basically, triple B or above rating is considered as suitable for investment, but it doesn't mean that people don't invest in double B or B C rated countries or firms. Even Sri Lanka, we don't have investment grade rating as a country. So to assess credit risk, we use credit rating as well. The risk is there are argument whether these credit ratings give us a proper assessment, because not each and every firm is continuously monitored. Time to time, credit rating agencies, they do their review. During the review period, in between two reviews, anything can happen. And the current market trends, economic conditions may have impact on corporates or sovereigns. Those may not be reflected in the credit ratings unless they do a rating agencies do a review. So therefore, whether credit rating reflect the future of a corporate or a firm, there's a debate. And the other thing is, any corporate or a sovereign who wants to get a credit rating, they have to make a payment to the rating agency. So rating agency's business or the income depends on the payment made by the corporates or the entity who wanted to be evaluated. Then the question is, since the evaluation is done based on the request and the income depends on that, whether the rating agencies provide a independent review, whether there is any bias towards the firm which is being evaluated. After 2008, 2007-8 crisis, it was very much debated, but still all over the world, credit ratings are used to assess the credit risk. But what happens, many large institutions, they started to develop their own internal ratings. That's why even in Basel, there are models to assess the credit risk based on internal models. Then say if a rating is downgraded of a company, what would happen? Any asset, that means, say, okay, take Sri Lanka as an example. We have issued international bonds, sovereign bonds. Sri Lanka has borrowed dollars by issuing dollar bonds in the international market. Assume at the time that we issue the bond, we were rated BB. Then the investors might ask, okay, we need 6%. 6% yield. We need 6% yield to buy dollar bond issued by Sri Lanka and government. What would happen? That BB rating is, if BB rating is downgraded to B+, one notch down, the credit risk of Sri Lanka has increased. Investors, they need higher return because they want to compensate the risk. So then what would happen? The bond initially traded at 6%. Now it may be trading at 6.5 yield. You know what would happen if yield increases of a bond? What would happen to the price of a bond? It will go down. So investors, they experience a loss. That is the risk that we are I mentioned at the beginning, downgrading the counterparty's credit rating. If a counterparty credit rating is downgraded, then investors may experience losses. Then to minimize credit rating, there are ways of doing that. Basically, concentration limits are specified. What does it mean by concentration? Give a limit to a exposure to a particular category. That category may be credit rating, based on credit rating, or maybe based on sector, or maybe for individual name, or maybe for individual country, and maybe based on maturity. Or it may be a combination of that. Say, you may have in your guidelines, investment guidelines or trading guidelines, for a AAA party with maturity of 5 years, you can have only 10 million exposure, like that. AAA, credit rating is AAA, maturity 5 years, the maximum exposure you can get maybe 10 million, likewise. And whenever the credit rating goes down, I mean, for firms or entities with lower credit rating, you assign lower limits. But firms with high credit rating will be assigned high concentration limits. They say sector limits also depends on the sector. The credit analysts, they will assess the sector performance and identify what are the high risk sectors, what are the low risk sectors where you can earn good income compared to the risk that you are taking. Based on that, they will assign sector limits. Name for a particular firm, considering their credit rating, in what sector the firm is doing business, things like that, and what is the domicile country of that firm, what are the currencies, assessing all these things to control the credit exposure to that particular firm, you may assign a limit. Okay, company ABC It's a double B rated one. So therefore, and it's in Bangladesh. So we should not invest more than $1 million, something like that. Country also matters, because not only a firm or the sector, even the same sector may perform differently in different countries. When you assess country, you have to think about the legal system, whether the currencies are freely convertible, what are the restrictions, whether there's any chance that country change the regulatory environment that may prevent you taking out your money back, things like that, and the political environment and political stability. Consider and the rating as well. Considering all those things, your credit risk team will assign a country limit. Maturity is also same. Why? So when you assess a counterparty, borrower, you assess based on the information available as at today. The chances of varying those information and increasing the default probability within a very short term period is very low. If you assess somebody else, somebody today, you come to know what is the situation. Then you can think that situation will prevail there for 1 month or 2 months or 3 months, like that. But the risk of changing that situation or deteriorating that party's creditworthiness after 1 year period or 2 year period is uncertain, very difficult to assess. When the time period increases, so what would happen in 5 years, 10 years, we don't know. The risk increases with the maturity period increases. Therefore, generally, for shorter maturities, you assign high concentration limits. That means you can lend to that party or buy assets of that party, like government, like bonds or debentures, for a short, with maturities of short period, but you get less exposure limit for longer end product, because this uncertainty is high for longer period. So these are some ways of controlling or managing credit risk. Assign concentration limits considering the factors given here. Or if you think you have to consider some other factors, yes, you can do that. Basically, in general, credit rating, the sector, the specific name, country, and maturity are considered when you assign concentration limits. Then to manage credit risk, there are other products, derivative products. Even in derivative class, we couldn't discuss this. Derivatives product. So I would like to switch into that derivative handout. Then we can discuss these products. So can you see this presentation now?
Yes.
Yes, you can see. Okay.
What is the heading? Yes.
Sorry?
What is the heading? This is separate presentation, so
Yes,
share
it's
with us.
this is the derivatives presentation that we discussed last. Before we start risk management, we discuss
That
derivatives.
is the okay.
No, this is the SOPs.
That is
On, there was a presentation on SOPs.
okay. All right. Okay, sir. Sorry. Got it. Got it.
So this is the first slide or the topic SOPs. We
Okay.
discuss currency swaps, interest rate swaps, cash flows, that one. So when we stopped here, we couldn't discuss these credit derivatives. So since we are now discussing credit risk, we can discuss this credit derivatives. There are three major credit derivatives: credit default swaps, credit linked notes, and credit spread options. So first we'll discuss about credit default swaps. Okay, I think better I'll move into so you can see the board. Yes.
Yes. Yes. We can.
Yes. Okay. Credit default swaps. In short, we refer it as CDS, credit default swaps.
Excuse me, sir. We can see the reverse side. Like need to. Now okay. I think. Now okay.
Now, okay. So credit default swaps. In a credit default swaps, this transaction is taken place between two parties. We call CDS issuer and the lender. These are the two parties between which these parties the transaction taken place. But we need to explain this, we need another party who is the borrower. Forget about that CDS issuer. We'll go back. We just discussed the lender and borrower. What is the relationship? Lender has lent some money to borrower. It may be just a facility granted or maybe buying a bond, whatever. The lender has lent to borrower. The moment you do that, the lender takes the credit risk of this borrower. Clear? The moment the lender lend money to borrower, the lender takes the credit risk of this borrower. Lender does not want to take the credit risk, but prefer to hold that investment because he gets the other interest income. If he would like to forego on the income that he generate just because of the credit risk, but still wants to earn the income. What he can do, there are parties, now this CDS issue comes into play. There are parties, those who like to take the risk of this borrower, credit risk, but they don't want to directly lend to this borrower, but would like to assess this borrower based on the assessment, take some risk on this borrower. So what's happening? This CDS issuer gives some sort of guarantee to the lender, in a default event. That means if this borrower defaulted, the CDS issuer will pay a compensation to the lender. If the borrower defaulted, the CDS issuer compensate the borrower. So therefore, this entity, the borrower, in this CDS environment, we call this as the reference entity, because the CDS issuer issued a CDS refer to this borrower, but the buyer of the CDS is this lender. Is it clear? Reference entity, CDS issuer, and then this lender becomes CDS buyer. So it's like buying an insurance. So therefore, to buy this insurance, lender has to make a payment, to the CDS issuer. That is usually quoted as in terms of basis points. What is the notional amount? What is the notional amount that the lender wants to secure? Based on this notional amount, out of this notional amount, some basis point has to be paid to the CDS issuer. So that is the basic concept. What I wanted to explain here, identified three parties: lender, borrower, and CDS issuer. So in this instance, borrower is considered as reference entity, CDS, and then we have two parties, writer of CDS or CDS issuer and the CDS buyer. That will move into this presentation. So in this, it says the party buying the credit protection makes a periodic payment or pays an upfront fee to the other party. So who is this party? This is the lender. Lender is the one who is buying the protection from the CDS issuer to get some protection against any credit risk event of the reference entity. So to get that protection, like since it's like buying an insurance, the buyer has to make a payment to the issuer, like in option, because this is sort of insurance. In return, if the reference entity, that means the borrower, default, or indeed we called if any credit event happens, the CDS issuer agrees to make a compensation to the CDS buyer. That means if the borrower defaulted or any credit event happens with related to the reference entity, CDS issuer make the compensation to the CDS buyer. So here we said credit event. So I think better to have some understanding on what does it mean by credit event. It's not necessarily a default. That's why in the CDS agreement, they enter in, they come to some sort of agreement. What are those credit events? It may be a material default. So assume it's a 5-year bond. After 2 years, the borrower fails to make a coupon payment. That may be considered as a material default. You don't, it is not necessary to be the last payment, the principal amount. Even a coupon payment, if the borrower fails to make a coupon payment, it is considered as a material default. Likewise, in the agreement, CDS agreement, they define what's a material default. If that material default occurs, then the CDS issuer make the compensation to the CDS buyer. Or it may be a bankruptcy event. Or it may be just a falling asset value. It's not necessarily a default, but maybe depending on the value of the asset. If value of the asset decrease by more than 25%, it may be considered as a credit default swap. That what is that percentage?
In Sri Lanka, sir,
Yes.
In Sri Lanka, sir, can we see credit default swaps?
I don't think. I haven't seen. Yes. In Sri Lanka, we don't have.
Okay.
So how the banks manage their credit risk without this, like
In Sri Lanka,
in Sri Lanka, how the banks manage their credit risk?
that's based on the limits that I specified earlier, concentration limits.
They don't use derivatives.
No, because we don't have these credit default swaps or the credit link notes or credit options in Sri Lanka.
So they have their internal controls only.
Internal controls, yes.
Okay.
And not only internal controls, the regulatory limits as well. There may be sector limits and others imposed by regulator.
Okay.
So the other credit event is debt restructuring. What does it mean by debt restructuring? So assume you have a 5-year loan. After 2 years, okay, the borrower feel like it is difficult to make this payment within 5 years, and the cash. So they want to restructure it. Maybe they extend the period for 10 years and change the coupon structure or something like that. Or sometimes they just write off part of the capital as well. So that if that debt restructuring occurs, that can be considered as a credit event, or merger or a demerger. That can. However, whatever the credit events considered in this credit default swaps should be mentioned in the CDS agreement. Different CDS agreements may specify different credit events. Not each and every agreement has the same. So, and there are 3 types of CDS: basic major types: basic, index, and basket. Basic is based on a specific asset. Even though I said that there's a reference ending, in a basic form, not all borrowings is covered in a credit default swap. This credit default swap may be linked to a particular asset. A firm, there may be, say, a firm has issued 10 debentures. 10 debentures issued at different times with different maturities. But the credit default swap can be written on a particular debenture. Then we call it as a basic credit default swap. So that's why it says based on a specific asset as reference to the credit event. So in that case, if all these credit events are defined in term with link to that specific asset, and in the index one, instead of a single asset, this may be based on a index like equity market index or some index. Then it's a much broader coverage. It gives a much broader coverage. Basically, in that index CDS, the buyer will get most likely purchase a protection if the index value falls below some certain level. Then the buyer of the CDS needs the compensation. Like that, he will get the protection for the deterioration in the index level. The third one is the basket. That again, in the very first one, basic one, we referred only to a particular asset. But in the basket, it's a collection of assets. Not all the assets, but collection of assets issued by a particular entity. Then the credit default, the credit event may define as, because there are more than one asset in that basket, how do you define the credit event? Whether it's out of, say, we have 10 assets in the basket, to consider it as a credit event, do we have to consider all 10 assets, and is it required to have credit event on all those 10 assets, or just 2 assets or 5 assets? Then we consider the credit event happens. That has to be defined. For example, I think, yes, there's an example on that. Before I move into that example, I explain if a default or if a credit event occurred, even though it says if a default should occur, generally, if a credit event occur, what would happen? There are 2 ways. First one is cash settlement. The other one is physical delivery. In the cash settlement, what would happen? After the credit event, still there may be a market value of that particular asset. Then the CDS issuer will pay the difference between the market value and the face value, or whatever the notional amount that you protected. The difference between the market value and the protected value, the notional amount, will be paid by the CDS issuer to the CDS buyer. Is it clear? The difference between the market value after the market value of the asset after the credit event and the notional amount that they agreed. That difference is paid by the CDS issuer to the CDS buyer. But in the physical delivery, whatever the asset, the ownership of that asset is transferred to the CDS issuer, and the CDS issuer will pay the full amount to the CDS buyer. Consider a bond with a face value of 100. Consider a bond with a face value of 100. So credit event happens, then the market value of that security is 50, face value is 100. In the cash settlement, CDS issuer will pay 50 rupees to the bondholder or the CDS buyer. The difference between 100 and the 50, the market value, that difference will be paid by the CDS issuer to the CDS buyer in a cash settlement. But in a physical delivery, the CDS buyer, the security that he is holding, has to transfer that to the CDS issuer. Whatever asset that you have, pass it to the CDS issuer, then the CDS issuer will pay 100 rupees because that is the full amount, notional amount that they agree. That is physical delivery. In the cash settlement, only the difference between market value and the notional amount will be paid by the CDS issuer. This is an example of basket. ABC, it's a bank, has a portfolio of airline leases and is concerned that higher fuel prices will hurt airline profits. Yes, that can happen. Airlines, major component of cost is fuel. They pay high price. They incur high cost on fuel. What would happen if fuel price increase? The profit will go down. Then the airlines may be not in a position to pay their leases. So to minimize that risk, what the ABC Bank has done, it has bought a basket credit default swap that is based on a portfolio of aircraft leases for 5 airlines. Remember, this is now there are 5 reference entities in this example because 5 airlines, different airlines. But collection is the basket. So put all these 5 airlines into a bucket and consider that is the basket. And the ABC Bank has bought a credit default swap from another party against this basket. The credit event is defined as define a credit event when the second of the airlines applies to restructure their leases. The credit event is defined as out of these 5, if 2 airlines apply for a restructure, then it is considered as a credit event. So assume 1 airline applies for a restructuring. So ABC Bank will restructure it. There won't be any claim that they can make from the CDS issue. They have to restructure whatever the existing facility, existing lease, then carry on. But now one party has already applies for a restructure. Assume later the second airline also applies for a restructure. The moment that happens, that triggers the credit event. The moment the second airline applies for a restructure of the facility, the credit event triggers. Then, depending on the contract, the ABC bank has to notify that to the CDS seller, saying that, see, now we have received 2 applications from out of these 5 airlines asking for a restructure. So the credit event has triggered, please compensate. Then what would happen? Either the CDS issuer will purchase all these leases and pay the full amount to the ABC bank. That's all about. I wanted to explain you about credit default swaps. Is there any question? And there's another term called CDS spread. That spread is the premium that you have to pay to the CDS issuer. Indeed, it's the difference between the yield that you are asking for this credit reference entity and risk-free rate. The difference is the spread that you have to pay to the CDS issuer to buy a credit default swap. The next product is credit linked note. This is a form of funded credit derivative, and it is structured as a security. That means a sort of bond, and with an attachment of credit default swap into the bond itself. In any credit event, the risk will be passed to the credit investors. Instead of buying that credit insurance from a single party, this credit risk is diversified or distributed among many investors. So the issue of the credit linked note is not obliged to repay the investors if the borrower defaulted. And again, in this also, borrower is different from the issue of the credit linked notes. So in this structure, it eliminates the third-party insurance provider like a CDS issuer, because that risk is distributed among many investors. So I'll explain the concept through this. There's a borrower, there's a bank, and there are a set of investors. What would happen? Borrower needs money and he borrows from the bank. The bank lends cash to the borrower. Now bank does not want to take the credit risk of this borrower. What does the bank do? Issue a credit linked note. So that means the bank is going to issue a bond which has a link to the credit risk of this borrower. It is announced to the market. Whoever wish to take the risk of that borrower, they can buy this bond. So therefore, the investors, those who want to take little more risk, and who is willing to take the risk of that borrower, they will buy this bond. So the interest rate that the investors get will depend on the credit risk of the borrower. And whatever the proceeds the bank receives by issuing CLN, that is credit linked note, the bank will invest those money in a high quality, low risk investment, like buying a government bond. That is the initial product or the way how credit linked notes work at the beginning. With the time, two things can happen. Borrower remains solvent, so borrower makes all the payments to the bank. The bank repays the note to the investors, individual investors in full. So investors happy, they take their return. But and meantime, bank get the returns on the less risky investment. So this is the best case. But what would happen? Borrower goes bankrupt. Then the investors become borrowers, creditors, not the bank. Bank goes out from the picture. Is there any claim that anything that investors can get from the borrower? It becomes a matter between borrower and the investors. Bank will go out from the picture. The bank will still collect the return on the high quality, return on the high quality investment that the bank made at the beginning. That's how the credit link note works. Is it clear? So I don't expect you to understand it, have a thorough understanding on this product, but have basic idea and of the product, how it works, what are the parties involved, and what is the mechanism. Then we'll move into the credit spread option. As it mentioned, as the name implies, it is an option on the credit spread. So before we discuss that option part, first we have to think about what does it mean by credit spread. So corporate bond, consider a corporate bond. We consider them as risky investment compared to treasury bond. That is a risk-free asset or the risk-free investment. Treasury bonds are, we consider treasury bonds are risk-free because treasury bonds are issued by government. It's the government obligation, so we assume government can pay it back without any problem. But the corporate, it's not like that. It is risky. So if you consider same tenor, one corporate bond and one treasury bond, the yields may be different. The difference between these yields, corporate bond yield minus treasury bond yield for a particular tenor, same tenor, that is called the credit spread. The difference between the yields of a corporate bond and a treasury bond with the same maturity, we call it credit spread. Then in an option, the strike rate is set for the credit spread, the spread figure, not on the yield, but on the spread. That means the yield difference between corporate bond and the treasury bond. Then again, like in any other option, to buy the option, the buyer pays the premium to the seller of the option. So what would happen? Now our underlying variable is the credit spread. Therefore, the strike rate is referred to a certain level of credit spread. What would happen if the credit spreads increases beyond this strike rate? The buyer of the credit spread option can ask the seller of the option to make that difference, pay that difference. So that's why it says buyer receives any difference between the actual spread and the agreed strike if the spread rises above that strike. So this is an example. Assume corporate bond yield is 3%, treasury bond yield is 2%. Then what's the spread? Spread is 1%. Treasury bond yield remains 2% for whatever problem in that corporate bond yield of that particular firm increases to 5%, from 3% to 5%. Now what is the spread? It is 3%, 5% minus 2%. It's wide. We call this the spread wide. On the other hand, it can narrow. That means corporate bond yield drops while the treasury bond yield remains same. So the difference between 2.5 and 2 is 0.5. So the spread narrows. But remember, not necessary that treasury bond yield has to remain unchanged. Only the corporate bond yield changes. Both can change, but whether the spread increase or decrease, that's what matters. If the spread increases from 1% to 3%, we call it widens. 1% to 0.5% or 1% to 0.9%, then spread narrows. These are the jargons used in this. So you will get a payment if credit spread widens. I'll explain it using an example. Credit spread option. We need a notional amount. Assume notional amount is 10 million. Assume strike 150 basis points. What does it mean? If the credit spread increases beyond 150 basis points, that difference, whatever the spread minus 150, that difference has to be paid by the option seller to the option buyer. Assume again it's a European style. And assume on expiry date, credit spread is 200 basis points. On the expiry date, the credit spread is 200 basis. Is it possible the buyer of the option to make a claim? Yes, because the strike price agreed is 150. Now the spread is 200 basis points. So there's a claim for 50 basis points. What does it mean? What does it mean by claim of 50 basis points? What does it mean by 50 basis points as percentage? 50 basis points equals 0.5%. So the buyer of the option will get 0.5% of the notional amount. The buyer of the option will get 0.5% of the notional. That means 0.5% into 10 million. The buyer will get $50,000 or rupees, whatever currency. Is it clear? The strike is 150 basis points. This is the CDS, sorry, credit spread. The difference between the yield on the particular issue and the Treasury bond. On expiry date, the spread has widened to 200 basis points. Whether it's widened or narrowed, but still remains above 150. So that difference, the difference between 150 and 200 is 50 basis points. So the buyer of the option will get this amount. $50,000. That's how credit spread option works. So credit spread options are designed to hedge against for the buyer or capitalize on changes in credit spreads, that is differences in their respective yields. What does it mean? The option buyer will get the advantage if the spread widens above the strike. But if doesn't happen, what would happen? What would be the gain for the seller? Assuming the previous example, instead of spread on the expiry date being 200 basis point, what would happen if the spread is only 100 basis points? The buyer cannot make any claim, but the seller has already collected the premium. Like in any other option, seller of the option collects the premium, that is his income, and there's no more payment if the credit spread remains below the strike rate. So that's all about credit derivatives. Is there any question? I'm not going to move forward with this other derivative products, CDOs or mortgage-backed securities and things like that. We'll skip that part. I wanted to discuss this credit derivative products. There are three credit derivative products: credit default swaps, credit linked notes, and credit spread. Remember, in the credit default swap and credit spread option, the buyer has to make an upfront payment to buy the protection. But in credit linked notes, it's not like that. The risk is distributed among several investors. So we'll move into this. We have so we are moving back to the risk management presentation. Basically, that's it. What we want to discuss in that presentation. Do you have any question so far? What we discussed in this risk management, including the credit derivatives.
So in Sri Lanka, what are the derivatives currently in place, like credit derivative?
We don't have any of these credit derivatives in Sri Lanka.
Okay. We have options. We have
yes, options.
Forward also.
Options, maybe interest rate swaps and forwards.
Okay.
But those are not credit derivatives.
Is there any specific reasons not Sri Lanka not to use credit derivatives, or like market is not
developed and developed? Yes, that's the even we cannot see a proper share market, proper government bond market, and financial literacy among people. So those are the issues. So say take an option. To buy the option, you have to make a premium.
Yes.
But on the expiry, you may not get anything because the market didn't move against you. So indeed, you are not in trouble. But to get the insurance, you have to make a premium. What happens in Sri Lanka? Someone will question, why did you pay this premium to this guy? At the end, you didn't get anything. Because you don't have the understanding about what are you doing. But now the insurance sort of things, now it's very established. People can understand why do we buy insurance. So nobody will ask, why did you pay the premium? But if you do option, that thing can happen. And on the other hand, you sell a premium, you sell an option, you collect the premium, everybody would happy. But in any event, if the buyer executes its right, you may incur a loss, or you may have to make a pay. Then people will question, why did you do this? So first thing, we have to understand, why are we doing these things? What is our objective and what are our risks? So without that understanding, it is very difficult to do these things. I think that's the major obstacle in Sri Lanka. Lack of understanding about these products, and not only that, market is not that liquid. Anything else? If not, we can move into foreign exchange risk management. Shall we move into this?
Yes, sir.
Okay. Now you may see that the topic is foreign exchange risk management. So to manage risk, you should know basics on foreign exchange, how the risk can arise. So whatever we discuss, most of the things what we discuss in foreign exchange, you should be familiar with those things. So what is foreign exchange? What is exchange rate? I think I don't have to explain it again, since we have discussed this enough. But the problem is whether this foreign exchange exposure matters. The answer is yes. Why? Any company or any firm or individual who does business with foreign country partners, foreign countries, they exposed to the foreign exchange risk. Why? Whether you sell to them or whether you buy from them, the price or your cost or your income depends on the exchange rate. You may pay in foreign currency or you may receive in foreign currency, and by the time you receive or pay that foreign currency amount, exchange rate might have, you may incur a loss or a profit. These are few examples extracted from some of the annual reports that explains to how that risk matters for them. See, in Nike 1, our international operations and source of supply are subject to the usual risk of doing business abroad, such as possible revaluation of currencies. Why? Nike? There may be a lot of suppliers from different countries. Or they may sell their products in different countries. So the risk of doing business abroad, that matters. Not only such as possible revaluation of currencies. You buy from suppliers in other countries. If the currency appreciate of that country, you incur a cost. So in the second example, Starbucks, they said in fiscal 2004, international company revenue in US dollars increased 32%. The revenue from international company has increased. Why? The reason is the US dollar weakened against Canadian dollar and British pound. So in that instance, they are fortunate enough to get a profit. But what would happen if the US dollar appreciate against Canadian dollar and British pound? They could have incurred a loss. McDonald's story also same. The weak euro, British pound, Australian dollar had a negative impact upon reported results. In terms of US dollars, weak euro, British pound, and all those things had a negative impact on their income. So foreign exchange rate varies very frequently within very short time. So the risk is high. This is dollar rupee exchange rate movement from 2005 to 2014. You can see even in very small time intervals it fluctuates, but in sometimes there are large fluctuations. Here a depreciation, here an appreciation, again a large depreciation, then gradual appreciation, then a huge depreciation in 2011. If someone can remember, what is this? This is the 3% depreciation announced by the government through its budget in November 2011. The government through its budget depreciated rupee by 3%. So they did it officially, announced through an announcement in a budget speech, but in sometimes they cry over the currency depreciation. Sometimes they did it by themselves, and then later they say currency is depreciated, it's not good. So currency, whether currency appreciate or depreciate, there are pros and cons. You can't say currency depreciation is good or bad. That depends on where are we. Okay, however, this shows you the risk, but this is dollar rupee. Indeed, dollar rupee variation is very low. We maintain currency, however. This is euro for the same period. You can see how volatile is it. 1.1 to 1.59, 1.6. That's the range. As a percentage, this may be more than that rupees. So currency, every second exchange rates moves. This is Japanese yen for the same period. Gradual appreciation and again a sudden depreciation. This is euro within few months. 30th July, within few days, 30th July to 5th August. You can see the ranges within a day. See, within a day, what could happen? So exchange rate is highly volatile. So that generates risk. There are three types of risk, FX risk: transaction, translation, and economic. I'll explain these three risks one by one. Transaction exposure, as the name implies, that arise due to a transaction that someone has entered into. So consider Sri Lankan exporter. What is the process of export and imports? How do you make the payment, or how do you receive it? You agree the price today. Say Sri Lankan tea exporter. Today, assume there's a tea auction today. They auction it. and the price of 1 kilo of tea is say $2. So you come to that agreement. Okay, I say 1 ton of tea at 2 rupees. Sorry, $2 per kilogram. You enter into that agreement today, but when will you receive that payment? You won't get it now. It will take times. You may ship the tea or the goods and do the documentation. You have to send the document to that end. They will accept it. They may, depending on the contract, they may wait until they receive goods, then only they make the payment, or maybe upon receipt of the documents they may make the payment. However, it takes time. There may be a time between the agreement and actual payments. During that time, exchange rate may vary. It may be in your favor or it may be against you. So that risk we call transaction exposure. So that's why it says impact of settling outstanding transaction entered into due to fluctuations in foreign exchange rates. So you have already entered into a transaction, but the transaction is not yet settled. That means you haven't paid it or you haven't received it. So there's a risk. The exchange rate moves during that period. That risk is there. That is we call transaction exposure. So therefore this deals with the changes in cash flows that result from existing contract. So basically these sort of exposures arise due to purchase or sales of goods or maybe services at a previously agreed price. The price is decided, then you deliver your goods, or then you receive your goods, or do your service or receive your service, and you will receive payment in a later date. The same thing can happen through borrowing or lending. You agree to borrow. By the time you receive that borrowed amount, the exchange rate might have moved and the amount that you received in domestic currency may be different than what you expect, or the payments also same. Not only at the borrowing or lending stage, but only on the maturity or coupon payments as well. You make the borrowing today in foreign currencies. Every 6 months you have to make the interest payment. You never know what would be the exchange rate on that date. To buy the required dollar, you have to pay rupees. The amount of rupees that you have to pay depends on the exchange rate prevail at that time. So you are exposed to the risk, exchange rate risk. Lending also same. You lend in foreign currency. You will receive cash flows in future in foreign currencies as coupon payments or interest income or principal repayment. But by the time that you receive that amount, to convert it into rupees, you have to apply the prevailing exchange rate. So, and it may vary time to time. Definitely it will vary. So you don't know what is the rupee amount that you are going to receive. So that risk is there. That is the transaction exposure. Then the second type of the risk is translation exposure. What does it mean? So this may not be a realized profit or loss. Mostly it's unrealized. Why? And this basically occurred due to a existing exposure. Like you have a financial asset or a foreign asset in your book. It may be a lending, or maybe you have purchased some shares of a foreign firm, or maybe you own the firm. You make an investment in a foreign country. So in your books, it will be recorded. But it will be recorded in rupee terms. Say you invest $1 million in India and establish a plant to produce whatever. You establish a plant by investing $1 million in India, but in your books in Sri Lanka, that $1 million will be recorded in equivalent amount of rupees today. But what would happen after 1 year period? That $1 million invested in India remains as 1 million. Assume no accumulation of profit or anything. That 1 million remains as 1 million. But in the books of the company in Sri Lanka, again, at the end of the year, next year, you have to convert that $1 million into rupees. At what rate? You have to consider the exchange rate prevail at the time that you convert that $1 million, or at the time that you are going to reflect that it in your books. Same $1 million asset in different years in your books in terms of rupees will reflect different values. It may be a gain or a loss. However, they are unrealized because it's just book entry. You have not realized that loss or profit, but it will be reflected in your P&L as well, or somewhere in your income statement. So that risk is there. You just translate existing exposure in your books. That is called translation exposure. So that translation exposure can occur due to investments, borrowings, or lending. Assume you borrowed $1 million. You convert that into rupees, fine, now you have rupees. But in the balance sheet, that $1 million liability should be reflected in the balance sheet. You don't record it in terms of dollars, you record it in terms of rupees. By the time that you borrow, say 30th June 2020, the exchange rate is 185. So $1 million will be recorded as a liability of 185 million rupees in your books. Initially, you recognize that in your books. But at the end of the year, as at 31st December 2020, you have to prepare your statements. How do you recognize that $1 million liability in your books? Now you can't reflect it as 185 million rupees. Why? The liability is in dollars, 1 million, it's fixed. If you have to buy $1 million, how much you have to pay in rupees? That depends on the exchange rate. So if dollar rupee exchange rate has increased from 185 to 186 by December 31st, 2020, your liability value in terms of rupees in your balance sheet will increase from 185 to 186. So your liability increases. Is it a profit or a loss? Your liability increases, that means it's a loss. So you have to report an unrealized loss in your income statement just because of the exchange rate change. And that is the impact coming from a liability in foreign currencies on your balance sheet. That is we call translation exposure. The third exposure that we discuss is economic exposure. We don't have any direct transaction with the foreign party. We don't have any asset or liability in our balance sheet or in our books, but still we may face this risk, exchange rate risk. That is we call economic exposure. To explain that, consider a firm which manufacture, say, rubber slippers, let's say. That manufacturer does not import any raw material, anything from outside Sri Lanka. No import. All raw materials, all labor, machinery, everything is he buys from Sri Lanka, within Sri Lanka. So no imports. And all the products, output, he sells in Sri Lanka. No exports. So no imports, no exports, raw materials and everything buys from within Sri Lanka, and the product is selling within Sri Lanka. No borrowing, the capital is raised in Sri Lanka, no borrowings or no assets in foreign countries. Everything is invested in Sri Lanka. So for a firm like that, there won't be any translation exposure or transaction exposure, because the firm does not import anything, does not export anything, so no transaction with outsiders, so no transaction exposure. No borrowing, no assets, nothing, no assets or no liability in foreign currencies on its balance sheet, so therefore no translation exposure. But what is the exposure then that firm gets? There are importers in Sri Lanka, those who import rubber slippers from other countries like China or Indonesia or Malaysia, wherever it is. Their cost depends on the exchange rate. What would happen if exchange rate appreciate? Sri Lankan rupee appreciate, what would happen? Cost of imports reduces. Those importers may be able to sell their products at a lower price. While the Sri Lankan firm, maybe its production cost is high, so that firm has to sell that rubber slippers at a higher price. What would happen? He will lose at least portion of its market share just because of the exchange rate appreciation. Exchange rate appreciates, goods of imports, cost of imports goods reduces. So in the local market, import goods are cheaper than locally produced goods. So the local producer will lose his share. That is the economic exposure. So even as individual, we all face that risk. We consume lot of things, import from foreign currencies, import from foreign countries, rupee depreciate, cost of those goods increases, still we have to buy, though we don't have direct transaction with a foreign party, we buy it from local market, still we face that risk. That is the economic exposure. Is it clear? Any question about on transaction exposure, translation exposure, and economic exposure? So here basically our focus is on first two types, transaction exposure and translation exposure. The economic exposure is very difficult or impossible to manage through financial products. It would be a business decision and how to manage the business. It cannot be done. The economic exposure cannot be managed through financial products, but it is basically, so therefore it's basically out of scope of our discussion, but we'll discuss how we can manage transaction exposure and translation exposure. So to do that, you should be able to identify the risk that you face, whether it's a transaction exposure or whether it's a translation exposure. First, we should be able to identify the risk. Then only we can select a product that we can manage or we can use to manage our risk. So is there any question? If you don't have any questions, we'll take a small break here before we move into how to use financial products that we have already learned to manage foreign exchange risk. So we'll take a 15 minutes break now. The time is 10:25. So we'll come back after 15 minutes. Any questions? Any questions? So if not, we'll continue. I hope you can hear me.
Yes.
Yes, okay. So we'll continue. I'll take few examples and explain how we can manage different foreign exchange risks with different products. In this example, it's a Sri Lankan exporter. It sells tea or its product to to other countries. And it says it recently received an order from a buyer in Germany. The sale is denominated in euros. Since it's German buyer, the buyer will pay it in euros, and the amount is euro 5 million. So the exporter will receive this euro 5 million on a future date. So therefore, the firm bears the exchange rate risk. So assume that the exporter enters into entered into this agreement on July 15th, and the payment will be on 15th October. What is the risk? If we classify whether it's a transaction risk or a translation risk, what is the risk? That's the transaction risk, because the Dilma, the Sri Lankan tea exporter, exposes us to the exchange rate risk just because of a transaction entered into with a German party. So there's a exchange rate risk and it's a transaction risk. There's an outstanding transaction to be settled. What is that outstanding transaction? Sri Lankan exporter to receive euro 5 million and to get equivalent amount of rupees. Okay, that's correct. It's a transaction risk. Then whether foreign exchange or the exchange rate appreciation or the depreciation, or rupee appreciation or depreciation, what is the risk? Rupee appreciation, is it a risk, or rupee depreciation? Is it the risk? Which one? What's the risk to the export?
Rupee depreciation.
Rupee depreciation. Why?
He's selling his goods for foreign currency.
He is selling
His goods and
his
obtain
goods.
foreign currency.
Obtain foreign currency. Okay, assume now he is going to receive euro 5 million. Assume now the 1 euro is 210 rupees. By the time that he enters into the transaction, value of a 1 euro is 210 rupees. If rupee depreciates, what would happen? The rate may be 215. Correct? If rupee depreciates, 1 euro may be somewhere above 210. Currently 210. If depreciates, it may be about 210. Say 215. Is it good for the exporter or is it bad?
Is it good for the exporter?
It's good. It's good for the exporter. Why? By the time he receives euro, he can sell that euro at a higher rate and get more rupees. So for an exporter, rupee depreciation is good, but rupee appreciation is bad. So from an exporter's point of view, the risk is rupee appreciation. So remember that from an exporter's point of view, the risk is local currency appreciation. Exporter will benefit from a depreciation of local currency. But if the local currency appreciate, exporter will lose So now that's what I said at the beginning. Just by looking at a problem in your hand, you should be able to identify what is the exact risk. Just because of it's involved in foreign currency, you cannot just say it's a foreign currency risk. You should be able to identify whether appreciation of local currency or depreciation of local currency gives you the risk, which gives you the benefit, which gives you the loss. That first we have to identify. Now the problem here is, or the risk here is, it's clear if rupee appreciates. Okay, what are the products that you can use to eliminate that risk? What are the products that we can use to eliminate that risk? Assume you are going to receive euro. You want to sell it and get rupees. So
Forward contract.
yes, your concern is when you sell rupees, whether you will get less amount of rupees. What you can do, one thing is enter into a forward contract. To do what? When you answer, give the complete answer. Just by selling forward contract, it won't enough. Forward contract to do what? What do you want to do?
To sell euro 5 million.
To sell euro 5 million. If you link that to this example on 15th October, because the date that you are going to receive euro is given. So one way of doing that is sell a forward contract on euro rupee to be settled on 15th October. Or simply you can say enter into a forward contract to sell euro 5 million on 15th October. So that's one of the action that they can do. So they can enter into a forward contract to sell euro 5 million, because in the forward contract we have to specify the currencies and the amounts. And what are we going to do, whether sell or buy? Sell euro 5 million, the value date 15th October, depending on the market condition, the rate will be decided. The 187.75, I just put it just to indicate that there should be a specified exchange rate.
So when we quote rate to an exporter, like how are we need to quote that rate? Say the market rate is 187.75. That means market bid is 187.75. If we
Market
need to
bid is
quote the
100,
rate to
okay,
87.75. Now if I am the bank, like we are going to quote that rate to our exporter, ideally what we need to do, like we need to add the margin, no, and we need to reduce the margin.
Okay,
like.
yes, good question. But okay, assume the market, in the market bid is 187.75. That means you act as a market taker. You are going to sell that euro 5 million in the market. Market bid is 187.75. So you can sell euro at 187.75. Clear? For a 1 euro, you will get 187.75 rupees. But what are you going to do? You are going to buy from the customer. So in that transaction, you are going to be the market maker. Customer is going to be the market taker. So what do? If you sell in the market, you can get 187.75. Now you are going to buy it from the customer. So what are you going to do? Buy from the customer and sell it in the market. So what should you quote to the customer? Should it be more than 187.75 or should be less than 187.75?
Less than 187.75.
Less than 187.75. So you deduct the margin from the market rate. Clear? So if we need 50 cents, the quote to the customer would be 187.25. Clear?
Okay. Yes, sir. And when it comes to import, other way around.
Other way around.
You have to add.
Right.
Yeah.
So once Dilma enter into this transaction, then on 15th October, what do you have to do? The company will receive euro 5 million. The company will deliver it to the bank and receives rupees 938.75 million. Whatever the exchange rate on 15th October, irrespective of that, the company will receive 938.75 million rupees. We don't worry about what is the exchange rate prevail on 15th October. Clear?
Yes, sir.
Yes. What other alternatives that we have? Now, okay, what are the problems or drawbacks of entering into forward transaction?
Forward contract is an obligation.
Forward contract is an obligation. So even on maturity date, even if the exchange rate is 200, you can't do anything. You have to sell it at 187.75. Whether it's 170, still you have to get it at 187.75. So whether it's a loss or a profit, you can't do anything. You have to do it at the agreed price. So you forgone your gain to mitigate your loss. That's the nature of the forward contract. So if you want to keep the gate option open, that if the market moves in your favor, you get that advantage, and if the market moves against you, you have the protection. What is the product that you can use? You want to keep it open to take the advantage, but not to get the loss. What is the product that you can use? On the maturity date, you can decide what to do. What is the product? That's the option. Option gives the buyer a right, not any obligation. Then buyer can decide whether to execute or not. In this example, exporter, what is the risk and what is his requirement? The exporter's requirement is to sell foreign currency. If you want to get a right to sell foreign currency, what type of option that he should buy, the exporter should buy? To get a right to sell, it should be a put option. To get a right to sell, the buyer should get a or buy a put option. So therefore, in this case, Sri Lankan exporter can buy a put option. The Sri Lankan exporter can buy a put option to sell euro 5 million. So by a put option, the notional amount would be euro 5 million. That's the amount that he is going to receive. The strike price, you can agree whatever. Say strike is 180. If it goes below 180, the Sri Lankan exporter still can sell euro at 180. If the exchange rate is above 180, the exporter can ignore the option transaction but sell euro 5 million at the market. But remember, what is the disadvantage of this? To get this, the exporter has to make a payment, a premium. So that's the cost in buying an option. Not only that, but what would happen? You buy a put option. If the exchange rate remains higher than the strike price, the option buyer, that means in this case Dilma, they can sell their euros at the market price. Forget about the premium paid, sell euro 5 million at the market price and receive rupees. But if the exchange rate falls below 180, whether it's 150, 180 or 120 or 100, whatever, or even 0, the company, the Dilma, can sell it at 180. Dilma can sell euro 5 million at 180 rupees. So all downside risk is protected. But definitely there's a cost. You have to pay a premium. There's another option, third option, that the exporter can do. Instead of buying a put option, he can sell a call option. What would happen if he sell a call option? If Dilma sell a call option, the Dilma will receive the premium. Exporter will receive the premium. So assume the strike rate is 188. Now what would happen? Expiry on 15th October. If the exchange rate goes to 190, what would happen? Dilma can sell euro 5 million at the market rate 190 and get that cash flow, but there's another obligation. The option buyer will come and execute his right. Then you have to pay the difference between 188 and 190. So effectively, Dilma is selling euro at 188. Clear? But
If there's a premium on this transaction, sir.
yes, that's what I'm good. Because Dilma has already collected the premium. So the effectively selling price of euro would be more than 188 plus the premium that you collect. Clear? If you forget about the premium, effective selling price would be 188 if the exchange rate remains above 188. So there's no unlimited risk because the option seller has this asset. Generally, option seller takes especially when you sell a call option, risk is high, unlimited. But in this case, it's not just a naked selling. The Dilma selling Dilma sells a call option while having euro in their possession. At least they are going to receive it. So therefore, whatever the difference between the strike and market rate, they can earn it by selling that euro 5 million in the market and transfer that amount to the buyer of the call option. Then they will collect 188 rupees plus the margin. So effectively they are selling slightly above 188. That's one side of the story. But what would happen if exchange rate remains below 188? If the exchange rate remains below 188, what would happen? The buyer of the call option will not come and execute. So the option will expire without executing. But Dilma will have to sell euro 5 million at the market price. Say 187. The euro can Dilma can sell euro 5 million at 187. So effectively, Dilma is selling euro at 187 plus the margin because the margin is collected. What is the risk? But if the exchange rate depreciates more than the premium that you collected, it's like you are losing. Say the premium for a 1 euro is 1 rupees. If the exchange rate goes to 185, your effective selling rate is only 186, whereas the strike is 188. So if it goes to 150, your selling rate is 151. So downside risk may not be protected fully because you still keep it open. But you will do this sort of transaction if you have some assurance that exchange rate or the rupee will not appreciate that much against euro. It will mostly remain closer to the strike. Basically, the best that you get if it remains below strike and above the break-even rate. That means strike minus premium. In between that, if the exchange rate remains there, you can sell it at the market price and collect the premium. Then the effective rate would be more than strike price. Clear? So this is from a exporter's point of view. But remember this third alternative, there's a risk. So you should enter into this sort of transaction knowing that risk. But in the first one, you are fully hedged. You exactly know what would be the outcome. When you enter into a forward transaction to sell euro 5 million, you exactly know what is the amount in rupees that you are going to receive. But in the second option, you know what is the minimum price that you are going to get. Since it's a put option, strike is 180, at least you get 180 minus premium. It's for sure. If the exchange rate remains above 180, you can get that minus premium. So the minimum rate is guaranteed here. minimum rate is guaranteed, upside is open. There's no limit. But in the third one, minimum rate is not guaranteed, but some cushion is there up to the amount of the premium. So therefore, third alternative may not be the best alternative, but some instances, depending on the market view, this may be a optimal solution. Any question? Now I'm going to move into the case of an importer.
So now here the Delma is the one who gets into the option. Like,
Yes, Delma is the buyer.
Then Delma is the buyer. He is going to pay the
Oh, sorry,
premium as well.
sorry. In the second alternative, Delma is the buyer of the put option. In the third one, Delma is the seller of the put option. Sorry, call option.
Seller.
Sorry, I cannot hear you.
In the third alternative, Delma is the seller.
Yes, the exporter is going to sell a call option. So then the Delma collect the premium. Yes.
What is the best alternative? Selling the call option or the selling the put option?
Again, that depends.
High risk is the selling the put option because no.
In the third option, the risk is high, but if exchange rate goes down, say 150, you can get only 150 plus premium.
Okay.
Premium may be few cents or 1 rupee. It won't be 20-30 rupees. So if the exchange rate goes that extent, 10-20 rupees down, you won't get a good rate. But that depends on the circumstances. If you think during this period rupee is not going to appreciate that much, it may be only few cents, or it's not going to depreciate that much, so it will remain or hanging around strike rate. If it is your view, then this would be a best option. But if you don't have any idea what would happen, you are willing to take some cost or incur some cost as a premium, paying a premium, but you want to keep the upside open, then second alternative would be best. You don't want to worry about whether exchange rate appreciate or depreciate. What you need, a firm cash flow in future, a non-cash flow in future, then forward would be the best, because you know once you enter into the forward transaction, you know what's the cash flow on 15th October. In this second option, selling buying a put option, you don't know what would be the exact cash flow. You have the minimum, you know the minimum amount, but you don't know what would be the exact cash flow. So depending on your requirement and view, best option may change, but in generally, considering you don't worry about, or you don't have to worry about the exact amount of cash flow that you are going to receive, and premium is not more than the related to forward, this may be the best option. Buy in a put. Anything else?
Okay, sir.
So then let's move into the importer's case. Again, it's a Sri Lankan copper wire importer. So it's going to buy copper wire worth of $500,000 with a Chinese supplier. So transaction date is 15th August. That means the Sri Lankan importer agreed to buy copper wire on 15th August, but the payment to be made on 15th November. So again, there's a transaction risk. Now, what is the risk to the Sri Lankan importer? Rupee appreciation or the rupee depreciation?
Rupee depreciation.
Rupee depreciation. The reason is on November 15th, importer has to pay rupees and buy dollars. If the rupee depreciated, that means the exchange rate has increased, gone up. Price of a dollar has increased in terms of rupees. So importer has to pay more rupees. What are the alternatives? Again, similar to the exporter's case, we have three alternatives. Think about what could be those three alternatives. First one, forward contract. What to do? To do what? What's the requirement of the importer? Buy dollars.
USD.
Buy US dollars. So the forward contract should be to buy $500,000 on 15th December. And you agreed the rate today, 186. This is the forward rate, not the spot rate. Remember, this is the forward rate. So then the importer knows what is the amount of rupee that he requires on 15th December. 186 into 500,000. Clear? So whatever the exchange rate prevails as at 15th December, the importer will buy dollars at 186. Exchange rate may be 200 or 150 or 170. Doesn't matter. The importer will pay 186 rupees per dollar to buy. Then the second one, what is the requirement? The importer wants to buy. Importer wants to buy. Which option gives you the right to buy? What is the option that gives you a right to buy? It's the call option.
Call
so
option.
Therefore, importer should buy a call option. Then specify the notional amount, the dollar amount that requires, that is $500,000. Strike. Again, he can decide the strike. Say, assume 186. Expiry date on 15th December. What is the cost here? Copper importer has to pay the premium to the bank or whoever sells the call option. The premium is a cost. But what is the advantage? If the exchange rate goes down, that means rupee appreciate, the importer can buy dollars at a cheaper rate. But in the event that rupee depreciate more than 186 rupees, importer can buy at 186. Clear?
Sir, here if exchange rate appreciate means importer can buy the dollars at the strike rate, is it?
No. But what does it mean by rupee appreciate? Assume current exchange rate is 185. What does it mean by rupee appreciate?
185 reduced to 170.
185 to 170. Okay, at what rate the option buyer will buy dollars? 170 or the strike of 186? You have bought a call option with the strike of 186. On the expiry date, exchange rate is 170. What do you do? At what rate will you buy? Strike is 186. You have bought a call option. On the expiry, exchange rate is 170.
Uh, 170.
Yes, you ignore the option, you let it expire, but you buy dollars from the market at 170. But if the exchange rate or the rupee depreciate and on the expiry date exchange rate is 200, what do you do?
Buy at the strike price, 186.
You buy at the strike price. You exercise your right. Then the seller of the call option has the obligation to sell you dollars at 186. Even though the exchange rate is at 200, the seller of the call option is obliged to sell dollars at 186. So you will buy dollars at 186 effectively plus margin, because you have already plus the premium, because you have already paid the premium. Your cost would be 186 plus the premium. Clear?
Yes, sir.
So then the third option, again like in the previous case, instead of buying a call option, this instance you can sell a put option. You can sell a put option. Again, that you assume rupee will not depreciate very much. It will remain around the strike price. And even if it appreciate, it may not appreciate too much. Then you try to get the advantage of the premium collection. That's the only protection that you get in this case, as well as in the previous exporter's case. The protection that you get on limited to the premium that you collected. So you do this when you think the market is very stagnated. That means remains at a very small margin.
Here the seller put option meaning we have Delma has the whatever the copper importer sell side to sell. Is it?
Yes, the copper importer has has sold an option to the other party, that party gets a right to sell dollars. So the buyer of the put option has the right to sell dollars at 181. Even if the dollar rupee exchange rate goes below 181, that means the 170, still this copper importer has to buy dollars at 181. Clear? So
Yeah, that means yes. Yeah, if the dollar rate on the spot date, expiry date, dollar rate come below the 181, he has to buy at 181 as well.
181. Yes. He won't get as an importer, he won't get the advantage of rupee appreciation. If rupee appreciate to 170, importer is happy to buy it at 170 instead of 181, but he don't have that advantage because he has written a put option. That means he has sold a put option. So he has to buy it at 181. That's why I mentioned he won't do that if he expects rupee to appreciate by a large amount. If it is by a large amount, he won't do this. But his expectation is rupee to remain closer to this strike 181, around 181 on the expiry date. Then he get the advantage of collection of the premium. Clear?
Clear. That means if the rate comes below the 181, the advantage is with the buyer of the contract, not with the seller.
No, not with the seller. Yes, buyer with the.
That means get into a put option is riskier than get into a seller call option. That means, is it correct?
In this one, no.
Yes.
You are referring to buying a call option or selling? Or are you comparing alternative 2 and alternative 3?
2 and 3.
2 and 3. No. Yes. The third one is riskier.
Third one is riskier. Yes.
Because so even dollar rupee exchange rate goes down to 100, he has to buy it at 181. The copper importer. So it's risky for him.
Similar to what our CPC get into the
Exactly. Yes. So that's why you can do this, but knowing the risk, you should get ready for that. But as an importer, mainly your risk is rupee depreciation. So it would be enough to protect that side without getting exposure to the downside. Okay, any questions? So here in alternative 1, in both scenarios, importer's case and exporter's case, I discuss only forwards. But there's another one similar to forward. What is that? Which you can't use in Sri Lanka, but in other countries, some other countries you can use that. What is that? FRA for interest rate, sorry, exchange rate.
Oh yeah, sorry.
Not FRA, but there's another product.
Yeah.
Similar to forward. What is the other product that we learn? almost same as forwards.
Swap?
No.
No.
Like a forward contract. What are the derivatives that we discussed? What are the derivatives product that we discussed?
Future.
Futures. We discussed forward, futures, options, FRA, swaps, currency swaps, and interest rate swaps. FRAs and interest rate swaps, inherently interest rate risk. Cross currency swaps, both exchange rate and interest rate. Futures can be, underline can be anything, but yes, in this instance, instead of buying a forward, if there's a market, you can buy a futures. What is the advantage of buying a futures instead of buying a forward? Or selling a futures instead of selling a forward? What's the advantage? Main advantage. You don't take the counterparty risk in futures because futures are traded through exchange and ultimately settled through the clearing house of the exchange. So you don't take the counterparty risk. But what are the disadvantages? You may not be able to match your requirement, the amount, because futures are standardized, the amounts are specified that you have to trade those amounts, and the settlement dates, which expiry dates, are given. It may not match exactly with your requirement. Those are the advantages and disadvantages in forwards and futures. So you should know all those things. Okay, that's the end of that presentation. Then we'll move into the foreign exchange risk management part 2. Here we are going to discuss mostly risk management, foreign exchange risk management in a treasury. Meaning, what are the controls and regulations that you have? Okay, before we move into this, I just got the confirmation for the revisions and to discuss questions. Yes, we will have classes here, physical classes, not online classes. So we get ready to come here. Most probably towards the end of October or at the beginning of November. Is it clear, the message? There will be classes at the IBSL for revisions and question discussions. There will be 2 sessions. That means 2 days. One day I will take one class. The other class will be taken by Perry. Whatever he discusses, he will discuss some questions and do the revision. Whatever I discuss, I'll do the revision, and topics that I discuss, I will do the revision and discuss few questions in that class. Apart from that, the other announcement is most probably by next Sunday or closer to that, we will post an assignment. We will post an assignment. Now we changed the initial plan. Initially we had 2 assignments, one with a group presentation, things like that, but now we can't do that. So therefore we decided to have just one assignment, individual assignment. So you have to do the assignment and submit. Probably there will be 2 questions in that assignment. You have to answer separately to those questions to make it easy, the marking our life. So you can answer 2 questions separately and submit it. Most probably you will get the assignment next week. We will give you probably around 3 to 4 weeks to complete the assignment and submit. Get ready for that as well. The assignment will cover whatever we discuss so far and maybe about to discuss in next 2 weeks. Because if you get the assignment next week, you will get another 3-4 weeks for the submission. So you can answer the questions based on the things that you are going to learn next 2 weeks as well. So get ready for that as well. Any question?
Sir, our exams will be most probably will be on December, right? As usual.
If there's no problem, we can advance it towards November, to the end of November. Because however you will get about 2 weeks after we discuss questions, and for the after revisions you will get about 2 weeks for studies. Then we'll have the
Sir, we missed about 2 months because of COVID, so that won't matter, no? The syllabus all covered, sir.
yes,
Syllabus all covered, no?
all covered. Only thing is the phase we move is little bit fast because of this online. So that's what happened. But all materials are covered. You can check.
Yes. Sir, is there any way to get some two extra days of revision for the things we did on online, sir?
That's
like,
what you will get 2 sessions here, 2 days.
yeah. Only 2 days, no, sir? We can make it
for
4, no,
revision
sir?
and discuss questions.
We can't make it 4 like to do the, because we had online classes also, sir.
So we'll that's beyond my control. Better if you all can make a request. I don't have any problem. I can do that. So you make a request.
Yeah, the overall sessions, if you can do, it's better, sir. Like the important parts.
Yes, probably yes. It will help you. Yes.
Okay, sir. Thank you, sir.
Okay, thanks. But make sure that you make the request. I'll inform as well. But you better you make a formal request. Okay, shall we move into this?
So what will be the structure of the paper? Is it MCQ? So how will it be?
So I prefer to have all MCQs, but the institution is not. So probably, have you seen the past papers?
No, sir.
No. So,
Are they available?
I think yes.
If we do come to the IGSL, sir, we
I'll ask
can
them
get that.
to at least post one.
Yeah.
Huh?
Yeah, better they can email it the paper, no, sir. Otherwise.
Yes. I don't know what's the arrangement. However, in previous batches, past papers were available. So we'll check that one as well. The structure would be there are 2 sections. section 1. Section 1, there will be 40 questions. Out of that 40, first 10 questions are to state whether any given statement is true or false. There may be true false questions, 10 questions. Not only that you have to state whether it's true or false, you have to justify your answer. If it is true, you have to write why. If it is false, you have to write why it is false. There will be 10 questions like that. Then there will be another 30 questions MCQ. So altogether 40 short questions. Then the section 2 is essay type. If I remember, there are about 5 questions. You have to answer 3 questions. In the second part, there will be 5 questions. Out of that, you have to answer 3 questions. Clear? Those are essay type. Essay types means you have to do calculations, explanation, write explanation, things like that. Interpret the results.
How many hours? Like MCQ
3 hours.
for 1 hour?
You have enough time. 3 hours.
So if you come to the IBSL library, are there books on Treasury Diploma, sir?
Not
Can
exactly on Treasury Diploma. So at the beginning, I distributed a list of books relevant to this. All those books are available at the library, IBSL library.
So would you mind sharing it again, sir? Because I didn't get it.
I think it's posted on this Google Classroom.
Oh, okay, sir. I'm sorry.
Check it. If it is not available, just inform me. He will.
Okay. Okay, sir. Thank you, sir.
Anything else? Shall we move to this then?
Yes, sir.
Okay. So this is about how banks maintains their foreign currency exposures and limits. Some limits are internal limits, some limits are imposed by the regulators. So we are going to basically discuss the concept of net exchange position or net open position and position limits, counterparty risk and settlement limits. What is the net exchange position? Net exchange position or the net open position, the definition is, as a bank or as an institution, you might have foreign currency assets as well as foreign currency liabilities. The difference between foreign currency assets and foreign currency liabilities in the same currency, because you can't add $1 million and euro 1 million together and say foreign currency asset 2 million. So if you get all assets in dollars and all assets in all liabilities in dollars, the difference is the net open position in dollars. If you take all assets in euros or liabilities in euros, the difference is net open position in euro. What is your exposure to euro? What is your exposure to dollar? That is the simple definition, but you can make it little bit complex by taking present value, because assets and liabilities, there are maturity dates. 1 million loan to be paid in 5 years, it's not same as 1 million spot transaction we have done today. So therefore, generally, it is the present value of assets minus liabilities. You take the present value of assets, you take the present value of liabilities. The difference is the net open position. Generally, you can calculate net open position for each and every currency. But that depends again. If you think you have one major currency to which you have the exposure, others are very small, then you can convert those exposures into that major currency. Say you have dollars, dollar is the major currency, but still you have some small assets and liabilities in euros, Japanese yen, sterling, Australian dollars. You convert all those into dollars and put it into the calculation. So then NOP would be only in dollars. That is also possible. But if you do that, you should know what are the risks in that and what is the implication of doing it. You should know how have you derived this NOP position. So just to explain, what does it mean by long position? When you have more assets than liabilities in a particular currency, that then it is said that you have a long position. So it is called positive position because the difference is positive. Asset minus liabilities, asset value is higher than liability value, then you get a positive figure. Then it is called a positive position or a long position. Or sometimes it is called overbought position because you have bought more in that currency. So this is an example. Here the currency pair is dollar and yen. So in the balance sheet there are assets in dollars and assets in yen. There are liabilities in dollars and there are liabilities in yen. So remember, when you go long or short in one currency, definitely you go short or long in the other currency. Because foreign exchange, there are two currencies. So here balance sheet comprised of just two currencies, dollar and yen. When you have dollar assets, you have yen assets as well as dollar liabilities and dollar yen. Now here we assume dollar is the foreign currency. We want to calculate the NOP in terms of dollars. So what is the amount in dollar assets? What is the amount in dollar liabilities? The difference, this gap, is the net exchange position or the net open position in dollars. That is the net open position in dollars, and it is positive. Why? Value of assets is higher than value of liabilities. But if you think yen is the foreign currency in this scenario, what is the picture? You have less amount of yen assets and high amount of yen liabilities. Then when you deduct liability value in yen from the asset value in yen, you get a negative number. So the net open exposure in yen is negative, but in dollars it is positive. So remember, whether you have a positive position or the negative position depends on the currency that you are referring to, and it's a relative thing. So this is a negative position. When we say it's a negative position, when the difference between asset value and liability value is negative. We call it as a oversold position as well. Same balance sheet, just because of we change the currency, it gives you a negative position. The other one is square position. That means your asset value and liability value are equals. Remember, square position does not mean that your asset value equals 0 and liability value equals 0. It's not. If you have asset equals to the value of liabilities, then the position is squared. That means you don't have any exposure to the exchange rate. If rupee depreciate, say, assume dollar rupee, dollar is the foreign currency, assets in dollars is similar or same as the assets in liabilities. What would happen? If exchange rate depreciate by 1 rupee, asset value also increased by 1 rupee, liability value also increased by 1 rupee. So there won't be any profit or loss. If rupee appreciate by 1 rupee, asset value will decrease in rupee terms, liability value also decrease by the same amount. So there's no gain, no loss. That's why we call it square position. There won't be any impact on the profit or loss due to exchange rate movements when you have a square position. But what would happen when you have a positive positive position or the long position? In this example, you have a dollar long position. What would happen? Dollar appreciate against yen. Dollar appreciate against yen. What would happen? Value of these assets, additional assets, will increase in terms of yen. So you get a profit. But when you have a negative position, so you have a negative position in yen, what would happen if yen appreciate? Value of your liabilities in terms of dollars will increase. So you may incur a loss. So depending on the position and the movement of the exchange rate, you will incur a profit or loss. But it won't happen when you have a square position. So a net exchange position arises when assets in one currency are financed through liabilities in another currency. So since total assets and liabilities have to match, we cannot be long in one currency unless we are short in another. So that's why I explained here in this. When you go long in dollars, you go short in yen, because this bank has financed dollar assets through yen liabilities. This difference, the additional dollar asset is financed through the same amount of yen liability. So when you go long in dollars, you go short in yen. So any currency pair, it should be the case. When you go long in one currency, you go short in other currency. So as I mentioned, net exchange position will give you exposure to the exchange rate risk. We'll see how the position and the movement of exchange rates will have an impact on your profit and loss. So we'll consider an example, a long position. What does it mean by revaluation? That means the base currency or the foreign currency appreciate. In this case, mostly we refer to the base currency, and we assess the position, net open position or the net exposure in terms of base currency. So you are long $1 million. That means against LKR. Sorry, it should be against LKR, not USD. What would happen? So, what does it mean by you have long position in dollars? That means you have more assets than liabilities with a value of $1 million. What would happen if the exchange rate, dollar rupee exchange rate, moves from 186 to 187? That means if dollar appreciates, remember, moving from 186 to 187, dollar appreciates, but rupee depreciates. So what would happen to your profit or loss if this happens? You have a $1 million. The exchange rate moves from 186 to 187. So the value of your assets will increase by rupee 1 million in terms of rupees. So therefore, you make a profit. You have a long position, the currency appreciates, currency means that foreign currency appreciates, you make a profit. The reverse is true if the currency depreciates. You have a long position, dollars against LKR, this should be corrected as LKR at 186, but dollar depreciates. That means the exchange rate moves from 186 to 185. So value of this 1 million goes down to 185 million. You incur a loss of rupees 1 million. So in summary, have a long position. If the foreign currency appreciates, you make a profit. If the foreign currency depreciates, you make a loss. Clear? Having a long position and the impact on profit and loss based on the currency appreciation and currency depreciation. I'll repeat it. Have a long position. Foreign currency appreciates, you make a profit. Foreign currency depreciates, you make a loss. Is it clear? Any question?
In Sri Lanka, normally position is maintained in dollars,
mostly in dollars, yes, because maybe around 90% of the transactions are invoiced in dollars. So most of the foreign exchange transactions are taken place in dollars. Even you do it in other currencies, banks, they convert exposure to dollars. So even if you want to do a rupee yen transaction, what do? You do a dollar rupee transaction and use this dollars to buy or sell against yen. So there will be a cross currency trade. Ultimately, exposure will be maintained in dollars. So then the other side of the story, when you have a short position. When you have a short position, if the foreign currency appreciate, you make a loss. Sorry, I'll repeat it. You have a short position. If foreign currency appreciate, that means in this case 186 to 187, the foreign currency appreciates, so you make a loss. But if foreign currency depreciate, you make a loss. Why? If foreign currency, when you have a short position, that means you have more liabilities. If foreign currency appreciates, the exchange rate in terms of dollar rupee, exchange rate increase. So value of your liabilities in terms of rupees increase. Liability value increase means you make a loss. If foreign currency depreciates, that means local currency appreciate, liability value will, in local currency terms, liability value decrease. So it's a gain or it's a profit. It's the opposite of the previous scenario. So this is the summary in a graphical form, but the currency pair is dollar and yen. So then how do you formulate a strategy based on your expectation? So if you think any currency is going to appreciate, if you think any currency is going to appreciate against another currency, so you go along the currency that you think which will appreciate. Say dollar rupee transaction, consider the dollar rupee exchange, dollar rupee currency pair. If you think dollar will appreciate, you go long dollars. If you think rupee will appreciate, you go long rupees. That means you go short dollars. If you think that currency is going to depreciate, then you do the reverse. You maintain a short position in that currency, which that you think currency depreciate. Because this is the same thing. Because when you think you go long one currency, that means you go short the other. You go long one currency because of you think that currency appreciate. That means you think the other currency depreciate. So this is the two sides of the same coin. So focus on one currency and formulate the strategy. It will be automatically reflected in the other currency. So then when you have a net open position, you are exposed to the risk. When you have a long position, thinking that that currency will appreciate, what would happen if that currency depreciate? You will make a loss. So there is a risk. Then how do we control that risk, manage that risk? That is one way of doing that is assigning a net open position limit. That means the maximum level that you can keep open, either short or long, there will be a limit. That is we call net open position limit. If you want to go long, say net open position is plus or 5 million, you can go long in dollars up to 5 million. You can go short up to 5 million. You cannot go beyond that. You cannot go short $6 million. You cannot go long $6 million. If the limit is there, your maximum exposure will be capped at that level. But when you express the limits, the banks, depending on their views and risk appetite, there may be symmetric limits. That means whether you go long or short, plus or minus 5 or plus or minus 10, whatever the limit is symmetric. Both sides, the same limit applies. Or there may be asymmetric limits as well. You can go long 5 million, but you cannot go short beyond 2 million. Or maybe you can go long only 2 million, but you can go short up to 5 million. That sort of asymmetric limits can be imposed. Again, whether it's symmetric or asymmetric, the net open position limits, there may be two broad types, especially countries like us, overnight limit and daylight limit. I'll first explain what is the daylight limit. That means during your business hours, during your business hours, what is the maximum net open position that you can carry? During your business hours, what is the maximum open position that you can carry? That is the daylight open position, net open position. But when you go home, at the end of the day, you go home, still you can carry a position. That limit is called overnight limit, because you never know what would happen overnight. So the risk is high. So therefore, generally, daylight limits are high, overnight limits are low. Because during the day, you are at the desk. If any adverse news comes out to the market or any adverse things happen, you can take a quick action. But overnight, you can't do that because you may not be at the desk. But for some currencies, it's true that you can place an order to with another party in another country. So then they will take care of your position. They will do the transaction accordingly. But it's not available in each and every currency pair. So say dollar-rupee transaction, you can trade only from 8 AM to 5 PM in Sri Lankan times, only in the Sri Lankan market. So when you go home 5 o'clock, the market is closed. In the midnight, there may be any event happens. The opening exchange rate may be far away from the previous day closing. So the risk is high. Therefore, overnight limit is generally less than day limit. Then the counterparty risk. We didn't discuss this. The counterparty risk in foreign exchange is that we discuss how to settle this foreign currency transaction. Say dollar-rupee transaction between two Sri Lankan banks. Assume the settlement date is today. You are the buyer, the other party is the seller. So if you are the buyer, before the end of the day, today, on the settlement date, you have to pay whatever the rupee amount to the other party, seller of dollar. It may be a Sri Lankan bank. You pay rupees, say you buy $1 million. So you have to pay 186 million rupees. You pay 186 million rupees to the other bank before the end of the day. But you will receive $1 million in New York time. By the time we go home here, even New York people are also in sleep. They haven't woken up. So they are not ready to do business. You may not get dollars even when you go home. It will be in midnight in our time. Within that time period, the counterparty may go bankrupt. For whatever reason, they may not pay you $1 million. That is we call settlement risk. You pay your due amounts, but you don't get your receipt. So you get the full exposure to the other party. Paid 186 million rupees, you didn't receive $1 million. That is the settlement risk, which is also called as Herstat risk. That because of a historical reason, there was a German bank called Herstat Bank. In the international market, at that time, the currency was Deutschmark. So there were a lot of transactions executed by Herstat Bank with other banks in other countries to buy Deutschmark against dollar. So Hofstadt Bank was supposed to receive Deutschmark and pay dollars. One day what happened, just after the closing of German business, regulator of the German banks decided to, or announces that they ceased the operation of Hofstadt Bank due to some reason. So what happened? All other banks, they didn't receive with the cease of transaction, cease of the operation of the bank. That bank cannot transfer any money to other parties. So none of the dollar payments was taken place. All other banks all around the world were in trouble. Even central banks had to intervene and give some liquidity to prevent the market collapse. That's what happened. So then only market participants bank realized there's a risk called this settlement risk. So that's why it's called Hofstadt risk. So if that happens, you get the full exposure. There's another risk which is called resettlement risk. That is, you know, even in a spot transaction, there's a 2-day time difference between trade date and the settlement date. Even during that time, your counterparty may go bust. Then what would happen? You haven't paid anything, you haven't received anything, so no loss. That's true. But you have entered into a transaction with that party for some reason. Now you are sure because of the counterparties no longer exist, that transaction won't settle. So you bought $1 million on behalf of a customer to meet your obligation. Now you are sure that you are not going to receive that $1 million. You are in trouble. You have to go to the market and enter into another transaction to buy dollars. By that time, market might have moved against you. Most probably that would be the case because one bank or one institution has collapsed. There will be a lot of uncertainty in the market. The exchange rate may move against you. So there's a risk. That risk is called pre-settlement risk. So this explains that concept, conventional settlement of foreign exchange transactions. So bank in London, bank A is in London, bank B is in Zurich. They enter into a transaction in $yen. So bank A has a correspondent bank in Japan and another correspondent bank in USA. Similar to that, bank B in Zurich also has a correspondent bank in Japan and USA. How do you settle this transaction? So bank A in London will instruct its corresponding bank in Japan to make the payment in Japanese yen to the bank B's correspondent bank in Japan. So in the morning or even before London people get into business, this leg will be settled in Japan because it's about 10 hours time difference. But the dollar leg, it won't settle. Bank B in Zurich will instruct its corresponding bank to pay dollars to the corresponding bank of bank A. This will settle in New York time. So in that almost 12 hours or more than that time difference, when Japanese market close and opening of New York market, there may be at least 12 hours. During that, the Zurich bank can bankrupt or seize their exposure, and Bank A in London won't receive dollars. That is the counterparty risk, the settlement risk. So once they experience this, to limit that risk, banks decided to set up limits, settlement limit. For each and every counterparty, you assign a limit. For a single day, you won't do more than $10 million worth of transaction with this party. So any single settlement date, the maximum amount to be settled with that counterparty would be 10 million. But every day you can have 10 million settlement. That's true. But on a particular day, you may not have the exposure more than 10 million. Similarly, in aggregate, what would be the pre-settlement exposure that you can have to a particular counterparty? It is also capped. That is called pre-settlement limit. But the risk in the pre-settlement is minimal because it's only the market movement. You don't get the whole limit. So therefore, pre-settlement limit is comparatively high. Netting. That's another way of minimizing settlement risk. What do you mean by netting? Say, between two banks, there may be a lot of transactions. There may be 10 transactions out of 4 that bank A may have to pay dollars to bank B. In the rest 4 transactions, bank B may have to pay dollars to bank A. So instead of paying the full amount by bank A to bank B and bank B to bank A again, what do they do in netting? Calculate what is the amount that each party has to pay to the other party in a single currency, then net it. Say bank A has to pay $10 million to bank B, and bank B has to pay $8 million to bank A, then the net amount would be bank A is paying $2 million to bank B. So you pay only $2 million. If you get any exposure and in an event of default of bank B, the exposure is only 2 million. But if it was not the case, you settle each and every transaction separately, you pay $10 million, then the whole 10 million is transferred to the other party, and you haven't received $8 million. So altogether exposure would be 18. So netting will minimize the exposure settlement risk. The other one, the recent developments, now it's very much popular, continuous link settlements. It is like our bond market. In any country, bonds are DVP. That means delivery versus payments. You deliver the bond, then you will get the cash. Both parties has to deliver whatever their obligation. In bond market, the seller of the bond has to deliver the bond. Buyer has to pay deliver cash. Then the middle party who is handling the settlement system will check whether the seller has delivered the bond and buyer has delivered cash. Then same time they transfer the ownership. Delivery versus payment. In the CLS, continuous link settlement, the same concept is used, but it is called PVP, payment versus payment. You pay, then you will receive. Both parties has to deliver the currency amounts in respective currencies to the clearing agent. Then the clearing agent will check whether both parties has meet the obligation. Then only the exchange taken place. So this is the illustration of that transaction. So Bank A will instruct its corresponding bank in Japan to deliver yen. So then the corresponding bank in Japan will deliver to the CLS party. This PVP mechanism is the central clearing house, continuous link settlement. So this yen is delivered to this party. Meantime, Bank B has to deliver dollars to this clearing. Once the clearing house sees that both cash amounts are available with them, then they will transfer the ownership to the other party. So transactions settle simultaneously. Both legs are settled simultaneously. If one, say, assume Bank A delivers yen, Bank B did not deliver dollar, so the clearing house will not settle the transaction. They will pay back yen amount to the bank. They won't pay that yen to bank. So that is the mechanism available in continuous link settlement. So this is now very common. With this development, there are some central counterparty mechanisms and many more arrangements to minimize this settlement risk. This concept can be used not only for the foreign exchange market, but any over-the-counter transactions which are not settled through a central party. Even derivatives, over-the-counter derivatives, now they are moving towards this concept which is called central counterparties. Even there's an ongoing project in Sri Lanka, even in the share market and government bonds and other FX transactions and everything to be settled through a central counterparty. Maybe in 3-4 years time, we will have a central counterparty settlement system in Sri Lanka. So there's an ongoing project now. So that's it about foreign exchange risk. So if you have any questions, you can ask. Otherwise, we can wind up today's session. So it seems there are no questions. So we will wind up. Yes, next week we'll try to discuss how to hedge interest rate risk using interest rate derivative products. So that will be the end of risk management sessions. Then we'll start with the final part, that regulations. So thank you very much.